Now, very quickly turning to that report, Coface has updated its assessment for 11 different countries in its latest Panorama Report on country risks, with mixed fortunes for some of the world's better-known economies, including Ireland and South Africa. Coface believes that recovery from the sharp downturn of 2012 is still some way away, and the report highlights a few strengths and a few weaknesses. For the details of the South African Economic Report to July 2013, we have Sejal Singh, lead analyst at Coface, joining us in studio. Sejal, thank you so much for making the time to join us. Now, what do the numbers tell us about the general health of the South African economy?
Well, Nazipa, it's not very nice. That's, I think, to put it in a very polite way. We aren't in the best condition. We are definitely in a stronger position than we were last year, however. So there are positive indicators telling us that we're on the right track. However, we need to improve in a number of areas, and it's not isolated, it's not a single sector, it's across the board, and it ranges from our socio-political environment all the way to our general private sector environment.
Let's look at where we're finding some feel-good stories. From a sectorial point of view, which sectors are responsible for the high performance where we see that, and where are we perhaps losing the plot and maybe have an opportunity to make up?
I think definitely all the statistics tell us that manufacturing is on the way up, and there's been some significant improvements. So we look at this as a really positive indicator, because it has been a focus of government and something they've put a lot of time and effort into, and we can really see that there's some significant rewards as such in there. Financial sector, as always pulls us up, but the main drawbacks, the biggest problems we have is agriculture and mining. And there, a shrinking environment, a poor skills problem in that particular sector, and a drop in output, which has been dropping consistently over the past 12 years, has all contributed negatively, and that's putting the biggest pressure on our GDP. And in addition to this, we have a significant trade balance deficit, and this is purely because we're importing too much. We need to cut down on imports and improve our exports, and that's the biggest problems that we're having.
Before I get to the trade deficit and the mining sector in particular, I want to perhaps take a step back and look at, with the right policies in place, where are the potential areas where we could see future growth that we perhaps are not realizing right now?
Yeah, I think it's very difficult. We're on a very low base. So in every single sector, there's huge potential for growth. But it's not as easy as identifying where the problem lies so that we may have a quick fix, a quick solution to it. Our biggest problems are skills, and that comes from an underlying education issue. And there's no quick fix here. It's 10-year, 20-year strategies to improve this. But we need to improve our education so that we can improve the skill sets available in the labor force. And once that is good, we'd get an improvement in entrepreneurship, we'll get an improvement in efficiencies, and we'll get an improvement in savings. And one of the biggest deterrents is our inability to attract a significant FDI, the foreign investment.
Direct investment, right.
So if we can improve our skill sets, drop labor costs, and attract more income, there will be improvement across the board. So it's not just a single sector, to answer your question. There's potential in all our sectors. Of
course, if we look at the World Economic Forum's competitiveness report, we see South Africa doing marginally better, moving from 41 to 39. In your view, is this significant enough, or should we be making greater strides? And most importantly, I perhaps want to get to, what is it that we need to leverage right now to see South Africa move higher in those rankings?
Okay, I think what's important to note is the reason why we've improved is because other countries have significantly, I'd say done worse than what they were a year ago.
Right.
So that is what it is. It's not a real improvement. And in order for us to improve dramatically, we should be closer to the 25 mark in terms of significant economies in the world. In order to improve, we need to leverage our financial services, so have a bigger role in the development of sub-Saharan Africa. We need to provide services in there, benefit from that. It will help with the trade deficit. It will help with the strength of the rand. It will also help in improving skill sets across the continent as such. So there is opportunity there, but just looking at the general business confidence index, it's because other countries are doing worse, not that we're doing any better.
Let's look at a comparison with the continent. I mean, we're hearing a lot coming out now that in the next 9 years, Nigeria should surpass South Africa in terms of GDP. In the World Economic Competitive Report, the World Economic Forum's competitive report, we saw Mauritius actually slip higher than South Africa in terms of those rankings. So comparatively on the continent, are we on a backward trend?
No, I wouldn't say we're on a backward trend. I think that other countries are developing much quicker than we are, and that's the biggest problem. Mauritius, it's more pseudo-performance. It's not real. It's not a true economy. There's a lot of holding companies, etc., that are there. It's a tax haven. But we need to be worried about the likes of Nigeria. At the moment, we contribute practically a quarter of the continent's GDP. It's 25%. However, a few years ago, we were at 50%. So it's slowly, our position is slowly being eroded.
Right.
And the mere fact that Nigeria has such a large consumer base, makes it a very attractive market. So once there's an increase in stability, and once the foreign investor can see this, he's going to move his money out of South Africa and into your more, I would say, previously risky markets where he can get a better return.
Sejal, I want to throw a curveball at you, because last week I was speaking to one of the chief representatives of UNCTAD, and they were saying that South Africa, alongside other African countries, should maybe be tweaking their growth policies right now to be more domestic or inward-looking, and seeking to tap into that domestic demand as against looking at an export-led sort of growth. Do you concur with those sentiments, and do you think that this is something the South African government would actually consider?
I think it would work, but that is very short-term thinking. In order for us to look long-term, we need to look at sustainability, not just quick fixes, not quick growth. At the present, our entire GDP is being, pulled upwards by consumer spend, and it's not the best way to do things. We're in a high inflationary environment, and it's just going to make matters worse in the long run. We need to be more export-focused. We need to be, more focused on development in surrounding states, and not just buying in from other countries. All we do by importing is improve other economies, not necessarily your own. So you're going the stance of the US, that's more what we should be doing, cutting imports and more funding export initiatives.